In this video, I'm going to demonstrate a mean reversion or reversal trading strategy. But this isn't your typical mean reversion strategy. It's simple, indicator-free, and surprisingly effective. The video will follow my usual video structure. Firstly, I'll explain the setup and all the rules, and then I'll show you some demonstrations of trades so that you can follow along yourself. Then I'm going to do some extensive back tests, testing 28 different Forex pairs. And then finally, once I've found some Forex pairs which the strategy is most suited to, I'll do some robustness testing. For those of you who have followed my work for some time, will know that I'm a big fan of price action strategies. I investigate how markets move, how they respond to certain price action. And then when I found repeatable patterns, I can then build trading strategies around that and then automate them. I use software, I use multi-charts to automate and take the trades for me once I've programmed the strategy. Now, the strategy which we're going to look at today, I got the idea when I was investigating how markets responded when the weekly closing price was in the lower end of its weekly range and the upper end of its weekly range. And I quickly discovered that some markets responded very well to reversals. So when the close was in its lower end of the weekly range, so it looked weak on a weekly bar, the following few days it would quite often reverse and rally. But that was just looking at one single weekly bar, which represents the trading range from the prior Sunday to the Friday. Sunday because we're talking about Forex markets here, which do open on a Sunday night. Although we're looking from Sunday to Friday, which is actually 6 days, it's actually broken down into 5 main sessions, or I might refer to it as 5 days. Now, seeing as how the markets responded to this pattern on the weekly bar, I thought, what if I created my own rolling weekly bar? What if I use daily bars, or in this case it will be 1440 minute bars, to make up this new rolling weekly bar? In a moment, I'm going to take you over to some slides where I've created some illustrations which will explain this much better than I'm going to do now. And we'll also have a look at some trade examples. But let me just try and quickly explain what I've done. If we were to look at this new so-called rolling weekly bar, as I call it, if we were to look at it on a Friday, then we'd be looking at the past 5 days worth of price action, which would be the same as if we were just looking at the one weekly bar. We'd be looking at the highest high and the lowest low, the open and the close within that 5 bar range. So on a Friday, it's going to be very similar, apart from the open and closes, but the range, the highs and the lows, are going to be very similar to that one weekly bar. But here's where it differs, because this rolls every day. Every day it becomes something different. So let's say we were looking at trade setups on a Wednesday. If we were looking at a normal weekly bar, then it would just show us data from the open on the Sunday until the close on the Wednesday. So it would just show us those 3 days worth. However, using my rolling weekly bar idea, we're still using 5 days. So it will actually go back and it will use the previous Friday's and Thursday's data as well. So we're always using 5 days, but it changes depending on which day we're looking at it. If we were looking at it on the Thursday, it would be using data from the Thursday, Wednesday, Tuesday, Sunday, which is including the Monday, and the previous Friday. So always 5 days. And it just shifts forward 1 day as we move forward 1 day in the week. Anyway, using this new weekly rolling bar idea, I ran some quick tests and I found some markets showing such consistency that the equity curves look like this. Now, let's go over to the slides. I'll show you the full setup, the rules, some illustrations, and then some demo trades. As you already know, I'm calling this the rolling weekly bar. Looking at trade entries, we're going to be using a 1440 minute chart, which just looks like a daily candle on Forex. Now, I'm using a custom session. Let me quickly explain what that is. Normally, a daily bar is built, depending on your Forex broker, from the open, which is usually about 1700 Eastern Standard, through to the close, which is about a minute before 16:59. Now, I'm using custom daily bars, so my bars are actually starting at 18:30, which is 90 minutes after the normal session, and then closing at 16:50, which is about 10 minutes before. So they're a little bit shorter, but what they're doing is they're eliminating the times of high spreads during the open and the closing time of the Forex sessions. So in this strategy, you'll notice I'll say buy next open. So the next open will be at a time of 18:30. Now I've tested whether you buy at just before the session ends at sort of 1650, 1655, or just after the session starts, and it really doesn't make too much difference on this strategy. Some strategies are very sensitive, but not on this strategy. So the first thing we need to do is identify the high and the low range over the past 5 bars. So we're looking at the highest high and the lowest low. That could have occurred 2 bars ago or 5 bars ago. We just want to know where's the highest high and where's the lowest low and record those values. And then we're looking at the close of this daily bar that which we're on. And if the close of today is within the lower 20% of that high-low range, then buy next open. And the opposite for short, if the close is within that upper 20% of the range, then sell short next open. Trade exits, very simple. We've got a stop and reverse, which means we're in the trade until we get a signal to enter in the opposite direction. So if we're already long, we stay long until we get a signal to go short, and then we exit the long trade and open a new short trade in the opposite direction. We've reversed the trade, that's why we call it stop and reverse. Number 2 is exit after n bars in the trade. After so many bars in the trade, it could be 5 bars, 10 bars, 20 bars, and I've got in brackets there, if before reversing the trade. We might have our n bars set up as 20, so we're saying once we're in a trade, we exit just after 20 bars. However, let's say we're in a long trade. If before the 20 bars is up, before that 20 bar duration, then we might get an entry to go short. Then what we do is we ignore the n bar exit and we take the short trade. Okay, so there will come a time within the strategy where if we set the n bars as 40 bars, for example, we're very unlikely to stay in this sort of trade for 40 bars before we get a signal to reverse the trade. And if we do get that reversal signal, we do reverse the trade. We don't wait for the 40 bars. Okay, so this exit after n bars only works up to a certain amount of bars. And then the third exit is obviously a stop loss, and that's just X amount of pips. The initial testing on 28 Forex pairs using Multichart's Portfolio Trader. We're going to be using that 5 bar range, that 5 daily bars to make up the range. And we're going to be using an upper lower threshold of that 20%. The first test we're going to be using a fixed exit after 10 bars. And then the second test is not using a fixed bar exit at all, it's just using that stop and reverse exit. So let's look at a trade example. I've got 2 trade examples on the chart. Let's look at the first one. So the first one here is, this is where we got the trade. We closed in the lower 20% of the range, and that range was made up of the 5 bars. So 1, 2, 3, 4, 5. We're looking at the highest high and the lowest low, which was on the current bar here. And the close is here. I've actually set this strategy to only take trades in the lower 5%, just so it makes it clearer for this demonstration. So the close here is within that lower percentage threshold, and then we buy next bar at open, you see there. And we've exited after just n amount of bars, 1, 2, 3, 4, and then we exit at the open of the next bar. The lowest low of the range, which happened to be on the current bar, and we looked at the close of this range, and that closed below or in the lower 5% of the range. So we entered, we bought next bar at open. Okay, looking at one last example, just in case that wasn't clear enough. Here's our 5 bar range. We've got our highest high, our lowest low down here, and then we've got our close in the lower 20%. In this case, it's actually in the lower 5%, and then we enter, we go long on the open of next bar. Okay, so I hope that illustration's all clear for you. Now we're going to have a look at how the strategy performs, testing it across 28 different Forex pairs. And I'm going to do that using Multichart's Portfolio Trader. But for those of you who just want to see the final strategy, the final markets and the final parameters which I've used, then you can skip forward in the video. I'll put a timestamp on the screen now. But for those of you who are interested in the development process, which I'm sure most of you are, then let's go and shortlist some of these 28 Forex pairs. Now we're in Multichart's Portfolio Trader. You can see on the left-hand side here the 28 Forex pairs which we're going to be testing. You can see we've got a date range from 1st of January 2008 through to the 1st of January 2023. Once I've found some strategies which I'm happy with and done development on, Then I can test some out of sample data. This data here we call our in sample data. That's what we're going to be testing and developing on. But then our out of sample data will be, in this case, from January 2023 through to the present day. At the moment I've got data through to July 2025. So about 2.5 years worth. Hopefully those strategies will continue to perform in the out of sample data in line with what they did in the in sample data. In this portfolio test, I haven't actually included any costs, but I do include costs as soon as we shortlist some markets and go further into the strategy development. By the way, the screen which you're looking at is the screen from my VPS, which is like a virtual cloud-based computer. That's what I run the software on. The one I've been using for quite some time now and can recommend is from Trading FX VPS. I'll leave their link along with a discount code in the video description if you're in the market for a VPS yourself. So the first portfolio we're going to test is using the following strategy settings. Range length, that's how many daily bars are going to be making up this weekly rolling bar, and we know that's going to be 5 days. Range percentage, I've got that set at 0.2, which is actually 20%. So we're looking for trades in the lower and the upper 20% of that range. And max bars in trade, that's our simple bar exit. So in this case, we're going to actually exit after 10 bars in the trade or 10 days in the trade. And we're not using a stop loss in this initial testing. So let's quickly back test those 28 markets. And here's the results. So essentially, I'm just looking for some relatively high net profit numbers and some reasonably consistent equity curves. So the first one, 19,000, not that great, 75,000 Australian dollar, Swiss franc. The equity curve is definitely going up, but for a large part, it's sort of spent going sideways. Euro, Australian dollar, reasonable net profit, but the equity curve's very inconsistent. Euro pound, £44,000, and a nice uptrending equity curve. That could be one to put on the shortlist. Euro yen, 684,000. Don't let that confuse you because that's yen. That's not equivalent to the likes of £44,000. And the equity curve is bad. I don't expect this mean reversion strategy to work well on any of the yen-based pairs. Pound Australian dollar makes a reasonable net profit, but the equity curve is pretty bad. Pound Canadian dollar makes a lot of net profit, and the equity curve is really nice, so that's going to go on the shortlist. Pound New Zealand, a bad equity curve, and that's about all. So let's now just change the exit. So bars in trade, I'm going to set it just to 150 bars, and that's not going to be 150 days or bars in the trade because, like I mentioned earlier, we actually get out of a trade if we get a reversal signal. So if we're in a long trade and we get signals to go short, then we're going to get out of that trade regardless of what we got as this bars in trade exit. So 150 bars, we're never going to stay in the trade 150 bars without getting a reversal exit. So it's like not using the bar exit at all. So back testing that. Australian dollar, Swiss franc, making decent net profit again. But the equity curve is fairly flattish, not the best. Swiss franc, Japanese yen, making a lot of yen this time, but a bad equity curve. Euro, Australian dollar, a bad equity curve. Euro Canadian. Equity curve's good in recent times, but the early part of the test was bad. Not the consistency which we want to see. Euro pound made good net profit last time and now, and the equity curve is as good as last time as well. Pound Canadian making some decent net profit again. And again, we've got a nicely consistent uptrending equity curve. Pound New Zealand is definitely going up, better than it was last time. And that's about all. So I think that there's a standout two pairs here, and that's Euro Pound, works nicely with both of the exits, and Pound Canadian Dollar. So I'm going to put those two markets in the shortlist, and we go over to multi-charts and look at developing those a little bit further. Now we're in multi-charts, we can look at those two markets a little bit closer. You can see we're looking at Euro Pound here. The date range is the same from January 2008 through to January 2023. And as I said, I've got some costs included here. I've got £30 in, £30 out, so a total of £60. We're trading 100,000 units, so that £60 is equivalent to 6 pips, okay? So the first thing I want to look at is that bar exit. Is there an optimal or an optimal range to use this bar exit? So we can run an optimization. And the variable, the input, is called maximum bars in trade. And I'm going to run an optimization between 1 and 40 in steps of 1. Here's the bars, 1 to 40, and here's the net profit. We're going to be looking at the net profit. If we look at the 2D graph, it gives us a better idea. And you can see from 1 bar, that's going to be very losing, right up until about 7 or 8 bars, we're actually losing money. And then you can see that it sort of progressively goes up and up as we stay in the trade for longer until about 40 bars. If I was to make this test even longer, go up to say 100, you'd see that it completely would flatline where we're not using the bar exit at all because we're getting signals to enter a reversal position. So what I can take from this is that the longer we stay in the trade, the better. So we might not actually use a bar exit at all. Let's do the same for Pound Canadian. Run the same optimization. And a similar story. Basically, we're seeing that the longer we stay in the trade, the more money we're making. These early figures do slightly concern me actually. For example, look here, look at 10 bars in the trade, we're making over 60,000. And then if we hold for another couple of bars, 12 bars, we're actually almost losing money. There's a difference of 60,000 just through 2 bars. That's slightly concerning, a bit of a red flag to me. So I'm definitely happier to not use the bar exit at all and stay in the trades as long as possible. So now let's look at the range length. Let's go back to Euro Pound. Let's do that one first. And let's run an optimization on that range length input, which is the amount of bars which makes up our rolling weekly bar. Obviously, a rolling weekly bar is 5 bars, but that might not be the best. So let's run an optimization on that. So this time we're going to be setting the maximum bars in trade, that's our bar exit, to 150. So essentially that's not working. We're staying in the trade as long as we can. Running an optimization on the range length from 1 bar through to 20 bars in steps of 1. Remember 5 is our default. And we see that from 1 bar we increase in profit all the way to a maximum of around 7. 8 is still working quite well, and then it starts to fall off. So we can see that there is an optimum area here of 5, 6, 7, 8. So let's select 7 for this one. And we can do that just by setting that. Let's run the same test on Pound Canadian. One through to 20. And we see a similar thing, don't we? But slightly later. So rather than peaking at around 7 or 8, this actually peaks around 12, 13. But I like the way that as we increase that range length, the profit increases quite nicely. We almost got a bell curve there. So let's use 12 for the range length. So we're going to be using 12 daily bars, which make up our range where we're looking at the highest high and the lowest low. The next variable or input which we can look at is that percentage, that range percentage. So let's have a look at what changing the range percentage does to the strategy. So range percent was currently set at 20%, but I'm going to test from 10% through to 50%, and I'm going to go in steps of 5%. And we can quickly see that the best is 15%, 10% isn't very good, 15% is good, 20% is pretty good, and then it starts to nicely just decline. So we can clearly see a peak of around 15%. So let's use 15% and run the same test on pound Canadian. We didn't change that range length, did we? It was 12. And we can see similar kind of results where we quickly see a peak and then it falls off. This time our peak is at 20%, so that seems to be the best. 15% does work quite nicely as well. Let's just set them both at 15%. And then the last test, obviously we need to look at our stop loss. Let's go and do euro, pound. And being a mean reversion strategy, especially on essentially a daily time frame, we're going to need a fairly wide stop loss. Narrow stop losses tend to destroy mean reversion strategies somewhat. So I'm going to test from 0 through to 5,000, and that's £5,000, which is equivalent to 500 pips. And in steps of £500, which is 50 pips. So 0 to 500, step 50. And we can see that using no stop loss does make the most money. Using a 50 pip stop loss is worse. Using 100 pip stop loss is really bad. And then as we increase, it starts to work a bit better and then sort of flat lines. So we could use 250, we could use 200, 250, 300, 350. Let's just use 250. And run the same test on pound Canadian. Again, we see that no stop loss is the best, 50 is pretty bad, and then it starts to go up as we increase the stop loss, and it probably would flatline if we tested for over 5,000 or 500 pips. I think we should probably go a little bit larger using this market, so let's use 400 pips for pound Canadian. Okay, so now we've looked into both of those markets in more detail and we've adjusted some of the parameters, and they are slightly different for each of the markets. We now have two options. We've got two different Forex pairs using slightly different parameters. The next thing we need to do is check the out of sample or the unseen data which we haven't used in the initial testing. In this case, that's going to be from January 2023 through to July 2025. So about 2.5 years worth of out of sample data. We'll do that in just a minute. But before we do that, if you like this type of strategy, this type of rule-based strategy, then you'll probably like my 22-page Beat the Market Strategy Guidebook. In there I've documented 3 more rule-based strategies, a little bit like we're testing today. And if you find the link in the description down below, at the moment you can get that absolutely free. We've already seen the net profit figures from when we were doing the optimizations, but let's have a look at the equity curves before we move on and look at the out of sample data. So firstly, euro pound. There's what the equity curve looked like. The green dots represent new highs. We have got a fairly big drawdown here, but then it did seem to recover quite nicely and has been working quite well up to the recent data. We already have seen we've got a net profit of 46,000. 65% win rate and an average trade of £129. That's almost 13 pips per trade. Looking at pound Canadian, 66% win rate, similar, a much higher average trade of $390 or 39 pips. We know we've seen $110,000 and equity curve, that's the equity curve looks like. Again, a bit of a big drawdown period here, but has recovered and been working quite nicely up to the recent data. The recent data heading up towards January 2023. But what does it look like after that? What does it look like in the 2.5 years worth of out of sample data? Data which we didn't use within this optimization or this development. So here they both are, euro pound, and they've both got data up to the last date, which is the 18th of July 2025. So it's including data from 2008 through to 2025. That's what the equity curve looks like. We can see we are making new highs. It's just rolled over a little bit recently, but we've seen much worse and we've seen recoveries. So I'm happy to say that that is making new highs. In fact, if we go to the detailed, remember before we had data up until January 2023, which is around about here on the chart. So everything from here to the right is the out of sample data. Average trade value is very similar, it's gone up a tiny bit. Percent profitable, about the same. And what about pound Canadian? Average trade value gone down slightly, percent profitable, pretty much the same. Equity curve, again, that is making new highs right up to recently. So anything from about here to the right is the out of sample or the unseen data. So I'm quite happy that both of these strategies have been making new highs into the unseen data. So there we have two potential strategies using the idea of that weekly rolling bar. As it turns out, that weekly rolling bar, or the bar made up of 5 daily bars, didn't actually stick. We used 7 bars and 12 bars. But the idea all stemmed from that original weekly rolling bar. And that's what a lot of my strategy development work consists of. Thinking up weird and wonderful ideas and then testing them on multiple markets and timeframes. When I find something which seems to work, I'll often develop it a little bit further. And then I'll watch it. I'll just sit on it, continue to watch it into future markets. And that's a little bit like the two strategies today. I've only just developed those, so I'll just sit on them. I'll watch them for another 6 months or so, check out the performance, see if it's in line with the backtest, and then if and when I'm happy with it, then I can take them live and start trading them in a real account. So I hope you've enjoyed watching this development process, and I hope you've learned something. I hope these videos are of value. Please let me know in the comments if they are. And if you have liked it, then please give the video a thumbs up and consider subscribing for more strategy videos like this one. Anyway, thanks for staying till the end. That's all for this video, but I hope to see you in the next one. Until then, this is Jared Goodwin, and thank you.